All right, welcome back to the channel. Hope you guys have a good and prosperous new year. It's currently January 1st of 2022, and I figured it's an ideal time to look back at all of my portfolios over the past 1 year, see how they've performed, take a look at my passive income, and give some projections moving into the trading year of 2022. So sit back, get comfortable, and if you guys enjoy, as always, leave the video a like, subscribe. It helps me out a lot with the YouTube algorithm. But let's get into this. Okay, so this is my main portfolio, and over the past 1 year, it's up 15.45%, and it's generated me $546 of passive dividend income. And it had a starting value of just about $7,800, and now it has a value of $35,000. Now, if we take a look at my Roth IRA, this is extremely passive. I don't really do anything with this at all, and it's composed of just 4 ETFs. They all have an equal 25% allocation, and the ETFs are as following: VGT, Divo, jepi, and the ARK Innovation ETF. Over the past 1 year, this portfolio is up 13.29% and has generated me almost $600 of dividend income, going from a value of about $21,000 to the current value of $24,300. And I haven't contributed any additional capital to this portfolio at all in 2021. Taking a look at the activity page on this portfolio, it's all just dividend income coming in from Divo and jepi and being reinvested. And recently, most of that dividend income has been going into buying more shares of the ARK fund as the price comes down, automatically lowering my cost basis. And my third and final portfolio is on BlockFi, and it's my crypto, which is made up right now of almost an even split of Ethereum and Bitcoin. Now, I only transferred my crypto into BlockFi, I suppose, on February 28th of 2021, so it hasn't been a full year, but even so, the portfolio has generated over $1,300 in interest payments. And we can see just how volatile the value swings of this portfolio have been over the past 10 months. Now, coming back to my main portfolio, in 2021, I did make a big shift in my overall strategy, and you can see that represented here in mid-October. And what I did here is I pivoted from having mostly individual companies to an ETF-heavy approach. And the main reason why I did this is because picking individual stocks is a really hard task. I do think I picked excellent companies. I did all the proper due diligence, market research, I looked at their finances. But when it comes to the ETF side of investing, there's currently so many diverse ETFs to choose from that no matter what your strategy is, there's great ETFs to satisfy that. And these right here are 3 of my favorites. And I just decided that I'd rather hold Divo than have 20 individual dividend stocks. And that's just a personal choice I made. And I also just became a huge fan of this strategy right here, which is going to be a focal point of my portfolio moving into 2022. And that's using the S&P 500 with a systematic S&P 500 covered call ETF. And the point of this is to give me the best of both worlds. I get exposure to a healthy amount of price appreciation and a high level of monthly income, all while following a passive index approach. So moving into 2022, my fund will have 3 major sources of passive income: Divo, jepi, and xylg. Taking a look at the most recent dividend payments of these funds, starting with Divo, they just paid out a dividend on the 31st of December, and the amount was 15 cents per share. And there is an overall growth trend in this dividend over time because Divo as an ETF is comprised mostly of blue chip dividend paying companies. And of course, this ETF and all of my ETFs pay out on a monthly basis. Now, jepi is the next one. Jepi is going to be paying me another dividend in just a couple of days at an amount of 45 cents per share. And my third and final major income source is xylg. They're going to be paying me a dividend just a couple days after jepi of a similar amount, 45 cents per share. And we're going to notice that the physical dividend payment, much like jepi, is higher than the previous couple of months. And the reason for that is because these funds generate income through covered calls. And generally speaking, when the volatility in the overall stock market is higher, the premiums collected by selling covered calls increase. And taking a look at the VIX, in the past month, the volatility has spiked, and that's why xylg and jepi have generated even more income. And coming back to my portfolio, this is another reason why I love this setup, because when everything is good in the market and the prices are going up, I will experience a lot of that price appreciation. But when we inevitably have more choppy and volatile downswings in the market, I will still win because I will generate higher levels of income. And finally, when it comes to the growth side of my portfolio, I'm not going to change too much here. One thing I am considering considering doing is introducing the QQQ, although there's a lot of overlap with VUG, which is a generic growth ETF. In fact, to be specific, there's a 56% overlap, so it's probably not necessary. Yeah, so that's my overall positioning for 2022. Now let me give you my thoughts and forecasts for the next trading year. So in 2021, the indexes did phenomenal. The S&P 500 is up almost 30% year to date. And this right here is the main reason why. So this is the PE ratio of the S&P 500, and it's currently trading around a 30 PE. And this multiple expansion is largely responsible for a lot of the price appreciation in the indexes. Now, I don't think the multiple is going to come way down in 2022, but it's probably going to hover around this zone. And my main reason behind that is because the Fed is changing their monetary policy, tightening up a little bit, tapering bond purchasing, and they're going to be raising interest rates probably multiple times. As mentioned, I don't think this is going to make the multiples come down and thus the value of the S&P 500, but I do think it will keep the PE ratio from increasing significantly in 2022. And if the multiple stays the same, the major driver in price should ultimately be the earnings and revenue of companies, which is growing. And I think this is largely going to be what dictates the price movements of the S&P 500 in 2022, not the multiple expansion. Now, luckily for us, even if the multiples stay the same, companies are earning more and more profits and revenue, so there should still be a healthy amount of growth in the indexes, in my opinion, in 2022. But I think the stocks that are going to perform the best in 2022 are actually the ones represented in the ARK Innovation ETF, because over the past 1 year, it's down 24% and is relatively cheap in comparison to the rest of the market. A major reason why this ETF was beat up so much in 2021 was because of the Fed pivot in monetary policy, but now that's all been priced in. So I think as long as the growth names in the ARK Innovation ETF continues to grow the revenue, which I think they have a good chance of doing, they will rebound quite nicely in 2022. And not to mention, this might be the year that the pandemic finally comes to an end, and this might be a pretty healthy boost to the overall stock market. But that's just my take on the situation, and let us know in the comments down below what you think. If you're still watching and enjoyed, give the video a like, subscribe to the channel, all the YouTube stuff, and I'll see you guys in the next one.